What's up, everybody? This is Jad from the Bliss Life. Today is episode 2 of Chat with Jet. I'm going to be talking about the Bank of Canada and how they raised the overnight lending rate by 0.25%. The purpose of this video is to really run through the ramifications. What does that mean? And answer the three biggest questions that I'm seeing time and time again, which is, should I get a variable rate or a fixed rate? Should I switch from my variable to a fixed? And 3, should I rush to pay down my very good variable rate mortgage or my fixed rate mortgage? So those 3 topics is what I'm going to be covering today. And if that interests you, then let's keep watching. Hit the thumbs up, hit the subscribe button if you just got to my channel. My name is Jet. I am a CPA MBA out of Montreal, Canada, and I love rambling on about topics that interest me, like stocks, finance, investment properties, and anything else that is of interest to you. So let's just get started. Let's go. Let's get straight to the first one. The first one, should I go variable or fixed? This is a personal question, and no one can really tell you what the best answer is. I can give you some information to help you decide. Historically, it's been that variable mortgages have always come out as winners, but there have been times in our history that variable rates have skyrocketed so fast that the fixed mortgages came out a winner. But in most cases, it was always the variable rate that was winning. So that is that. But the other point is the nature of these products, right? Fixed mortgage, it has a lot of benefits. Fixed mortgage means you have a fixed payment. You start the term with a certain balance, and at the end of the term, you know that's going to be your balance no matter what. And during that time, the payments are always the same. So that's great, but you're paying for that peace of mind. And the bank is covering itself to make sure it has enough spread in case variable rates go up, it still comes out profitable. So there's that. Variable rates, there's 2 types. There's the closed and open. Closed means your payments are fixed, and what waves or what varies is the interest portion and the principal portion. So let's say you get a closed variable mortgage, your interest portion is this much and your principal portion is this much. But if rates start going up, then your principal decreases, but the interest portion increases. The payment's still the same. You're still paying the same amount, but the interest has increased and your principal is less. So if you're bad luck Brian and you for whatever reason you get screwed on this, it is possible that you can start a mortgage, then variable rates skyrocket to a certain point, and at the end of your mortgage term, your 5-year term, you still owe the same amount. Because all that's happened in that time, yes, you've been paying the same, but interest has gone up so much that your payments are all just going into paying off the interest, and very little is going off to paying the mortgage principal. So that could happen. And then in a open mortgage, what that means, open variable mortgage, that means your payments are just going to keep adjusting itself as the rates go up. So your payments are not fixed. And the good thing is that you're still going to get to the end of your term and you're still going to have what you expected. You expected to have start at 500 and then end up at 450. Well, you're going to end up at 450. And that's because your payment is always changing. This might not be in the interest of everyone, especially people who work and live on a tight budget or a fixed budget. They might not like to know that their rates can go up and down and then the payments can go up and down. It can easily lead to default. So all of that being said, you have to decide, okay, well, if you're very anxious person, or you just want to have that peace of mind, then go with fixed. If you are comfortable playing with fire a little bit, just a little bit, and your payments are going to be the same, but your principal and your interest portion can change, then do closed variable. And if you really don't care and you're just like, yeah, I got money to blow, I just want to see if I can ride with the lowest rates as possible for the longest time as possible, but at the end, I want to know that my principal is going to end up the same, and it's going to finish the way I expected, then get open variable. Now, with all of that being said, the key takeaway for anyone would be comfort, peace of mind, and the likelihood of rates going up. Like, how many rate increases can we have? I was looking at Bank of Canada's average interest rates, or the rates that they've had since 1975. And for the last 20 years, the highest prime rate was 7.5. The average for the last 22 years was 3.86 prime rate. So when banks are offering you like prime -1, then if the average was 3.86 for 20 years and -1 is 2.86, then if that's your variable mortgage rate, that's pretty good. So it really depends. You have to decide for yourself what is the best direction that you want to go, because it will allow you to sleep at night. Now, point 2, the second question. I'm on variables. Should I switch to fixed? Is it a good idea? That, again, it depends. The first thing it depends on is your mortgage product. Does your mortgage product even allow you to do that? Can you actually switch from variable to fixed? And if you do, what's the penalty? Some penalties are based on just 3 months. It's arbitrary, just 3 months. That's it. Some would be based on how much of a term is left. Some would be on nothing. You can't change, and you only can change if you're selling your house. So that only you know. B, some banks might start to be more risk averse now. They might say, okay, well, we need to look at your situation. What's your situation today? Is your paperwork in order? If they pull out your credit report, if they check your finances, would you be able to switch to a fixed? I'm not sure if all banks do this, but when you go to have that discussion, be ready for that question, because it is possible that they can ask you for that. And then the third point is really, what does your gut tell you? Well, how many rate hikes do you see? And when all those rate hikes come into fruition, the average rate you would have paid at the end of the term, would that rate be higher or lower than the fixed rate you would get today? Because if you switch from variable to fixed, you're not getting a special promotional fixed rate. You're just going to get the posted fixed rate in most cases. And those rates are generally high. You're not switching from one bank to another to try to get a promotional rate. Usually it's in the same bank. So that's something you have to think about. And that's something I was thinking about today. I did a scenario, and I'll share it with you. It's nothing scientific. It's very simple. But what I did was I asked myself, okay, well, I'm rolling at a 1.7 rate on a 30-year mortgage for an investment property. 1.7 rate, it was good. I'm happy. So far, I got 1 year, 1.7 rate. I still have 4 years left. So then I asked myself, okay, well, should I switch? Should I switch? And I was just like, let's see. So I will show you that file right now, and we can look at the details together, and I can give you a good feeling for how I came to my decision to not switch, and I don't think it's worth it. So let's look at that right now. All right, so in front of you right now, you have 3 tables. The far left is the best case scenario, the middle is a moderate, and then the right is the worst case scenario. The first thing I want everyone to take away from this is I went and pulled out the Bank of Canada rates for the last 70 and not 75 years, since 1975. And the prime rate is what concerns me, because I roll at a prime rate minus 0.75. And most people on variable roll at something similar. That's prime -1 or prime whatever, okay? So I roll at prime minus 0.75. Now, the average for the last 22 years was 3.86. The minimum was 2.25. The maximum was 7.5. And the median was 3.45. So that's like the middle rate. So the average is 3.86 for the last 22 years. Great. Now, what I do need to say is I built my table to first show where I'm at. I rolled at 1.7 for the full year. So 1 year out of 5, I got 1.7. Luckily, or hopefully, or the word is unfortunately, Bank of Canada announced in 2022 at the end of March, so end of Q1, that they're going to raise the rate 0.25. And my bank has already confirmed that my rate is going up 0.25. It's done. It's confirmed. It's going to be effective as of tomorrow, or already right now. It's midnight right now. So the first thing I did, okay, let's start with the worst case scenario, because if you don't have a lot of time, the best thing is to look at the worst case scenario. I laid out a map, a roadmap, and it's by quarter. Okay, so the first year is done. Then we got year 2, year 3, year 4, and year 5. At the end, I have to pay my mortgage. I mean, I have to renew. So in the worst case scenario, what I'm doing is ridiculous. Okay, it's a ridiculous scenario. It's not gonna happen. It's never gonna happen. But I'm doing it just to show you something. The worst case scenario is next month in Q2, in April, right away. They say, we're hiking it up 2%, raise it 2%, not 0.25, not 0.5, not 0.75 or 1. We're raising it 2%. That would blow things up, but they're doing it. So we go from 1.7 to 3.7. My variable rate instantly goes up to 3.7. And then after that, we have one hike each year for 0.5%. At this point, right away in Q2, remember I told you this is my mortgage rate, my variable rate. So it's 3.7 plus 0.75. That's what gets us to prime. Right here, we already busted the average prime rate. The average prime rate was 3.86 for the last 22 years. In this scenario, prime rate would be 4.45. Instant bust. It's done. Blown out of the water right away. So this scenario is very, very bad. Now, it goes up to 3.7. Then in Q1, in year 3 of my mortgage, it goes up again, 0.5. And then again in year 4. So now we're at 4.7. And then again in year 5 to 5.2. But the average rate that I got, when you walk away, it's like, oh, despite it being a complete shit show, I'm walking away with a 3.8% on average. Not bad. Rate Hub, 5-year fixed rate, today. What's available? They have a best market rate with some, most likely a B lender. But let's look at the banks. The banks posted rates are 3.2, 3.1, 3.1, 3.2, and 3.1. So in this kind of scenario, you know, it's worth it. Like, oh man, you know, I have a 3.8. I would end up in a 3.8. Maybe I should switch to these banks and try to get a 3.1 if I'm at one of these banks. I mean, I should try to get a whatever they're offering me, you know. But the truth is, your rate might not be that good at your current bank. It might not be that generous. So you switch from 3.8, and then also depends on your penalties. What are you going to have to pay up front? Do you have, you know, what would be your real rate? You know, even if you tell them, yeah, bake my penalty into this rate, this 3.2 might be a 3.3, 3.4. So in the worst case scenario, where we have an instant hike to 2%, by 2% to 3.7, and we bust the average prime rate of the last 20 years right away, it's really not that bad. 3.8. It's not that bad. Now let's look at the moderate situation. The moderate situation, it's maybe probable. Every 3 months, they raise 1%. I mean, they raise 0.25%, and it's 1% a year. Now this, I can kind of get behind. It's not going to create shock waves, but it's going to moderately raise the rates. And with time, we will cross at this point in Q2 of year 3. So the third year, or like not this year, but next year, we would hit the, we would bypass or exceed the average rate of 3.86 of the last 20 years. But again, the average, if we keep increasing 0.25 per quarter or 1% year over year, we would end up at a 3.36 average. Like my average would be 3.36. But if I try to switch today, Most of these banks are only offering 3.2, 3.1, 3.1, 3.2. So once you factor in the penalties, it's not really worth it in the moderate situation where we would have a 1% hike a year. It's not worth it. And then in the best case scenario, this is where, you know, I think maybe Bank of Canada will be reluctant because they do know that Canadians have record debt. Maybe they would do a 1% hike for the first 2 years, but then after that, it would just be 0.5% per year. And in that type of situation, for me, I would essentially end up at a 3.35. So it's not a big difference between having a hike every quarter versus having 1% hike for the first 2 years, and then you have a 0.5 and then a 0.5. You would still end up at the same place. So that's what I did. I did this analysis. It's not a big science project. It's nothing complicated, but it kind of highlighted to me, like, there's a lot of things that I value in my life. It's my time, not being stressed out, not having to do the dance with banks and trying to prepare the paperwork. It's really complicated. So if I was to, you know, if you tell me that this situation does unfold and it's a 1% hike per year and we end up at 5.65 at the end of 5 years, I'm not going to be mad because I know my average was 3.4. And then when you tack in the 3.4, if you add to that the penalty that I might have to pay to switch, the time that I spend going through the paperwork, like, it's not worth it for me. Now, granted, the big thing is, are these rates really true? You know, if I go to my lender and I say, hey, RBC, I want to switch my variable, are they going to give me 3.2 or are they going to give me 2.2 or 2.5 or 2.6? Because maybe what's on the website is not really accurate. So that's something everybody should ask themselves. But, you know, for me, an investment property, the interest is deductible anyways. So I'm not gonna stress out about that. Now, the third point, and this point really annoys me, and it shows how it goes back to my first Chat with Jat video where I talk about good debt versus bad debt. And it's people who say, wow, I have such a good variable rate. Like, should I rush to pay down my mortgage? Like, should I rush to pay down my mortgage? And the question is, if you have a really good variable rate that's under 3% or a fixed mortgage rate that's under 3%, so 1, 2, 3, why would you rush to put your money into that to win or save 3%, you know, pay 3% down on the money that you're borrowing when inflation is 5% or 6%? Why don't you take that money that you have and invest in stocks and save that money for a down payment? Because paying down debt when it's less than inflation's 5 and the interest rate is 3, it's free money. Like, the mortgage is paying for itself because the property value should be increasing at 5% or something if inflation's that high. So why are you rushing to pay down your mortgage? It makes no sense. Take that money, invest in something where you would make 5-6% a year. Even just buy the safest, you know, buy just an ETF like FIE, which is just largely focused on bank and financial institutions in Canada, and they pay 5% dividends a year. Just do that. So put your money into that, grow that 5%, grow your cash, and then at the end of the term, put a down payment pay down your debt if rates are super high at that point, or buy another property or do something else. Why are you rushing to pay down your mortgage? Like, like you're missing the point. And if you have a really good mortgage rate, like 1.5 fixed, and it's amazing, then remember that debt is only having 1.5% interest on that debt, whereas the market inflation is 5%. So the property is going up definitely more than 1.5% a year. There's no reason for you to rush and pay that down. Take your money that you're using to make extra payments and invest it in something and grow that. So then at the end, you can decide, okay, let me buy another property, let me invest in this, or let me make a principal, let me pay down my principal at the end of the term, because now rates are much higher at like 6-7. But don't rush to pay down your debt. Like, that's just something that people who weren't financially educated, or are not financially literate, would think. And you shouldn't do that. And I'm telling you why. Because it's free money. Don't do it. Where if you have a mortgage less than 3%, it's free money. Don't rush to pay that off. Take your money that you're saving up, extra money, do something else with it. Go on vacation, invest in yourself, go pursue an extra certification, or go to school or something. Don't do that. It's not worth it. Now, that's it for Chat with Jet. It's a short video today because it is 12:45, but I do know this is a hot topic, so I wanted to just touch on some key points for everybody. If what I've mentioned is applicable for you, then definitely hit the like button. Before I forget, just to add some few points, everything that I've mentioned also applies to a home equity line of credit, also applies to your unsecured loans. So evaluate, if you want to call up your bank for your unsecured loan and say, oh, well, I want to enter into a fixed payment plan, can you give me a fixed rate over 5 years? Evaluate if it's really worth doing it. But I would just roll at variable if you have a good variable rate. But if your rates are like 9% line of credit, then you're worried it's going to go up to 15 and you can negotiate a lower fixed rate, then definitely do it. Same thing for a home equity, but the principle is the same. So if you like what you heard, then definitely give me a like. If you have any questions, drop it in the comments. And if there's any mortgage brokers watching this and you feel you're so excited to correct me, feel free to correct me. I always want to learn. I'm not a mortgage broker, I just know the basics. So definitely it is something that I'm looking forward to learn more about, so don't hesitate. So that's it for me. All right, so I got the big screen on, so that's it for me. And I got two of myself now, but yeah, that's it for me. And I'll see you on the next one. Thank you so much. Bye.